about Levi Strauss, and I used to wear those jeans. I don't wear them any longer, but I know a lot of people do. They're in the industry of apparel manufacturing. Short is only 6%, no problem there. Institutional owned is 86%. PE ratio, decent start here, 19.7 versus 21.5 for the industry. Price to sales is the same as the industry at 1.1. Price to book value 3.5 versus 2.8. Price to cash flow 10.7 versus 9.3, and the PEG ratio is very good, 2.3 versus 20.2. So not paying too much for this company compared to the industry. Now there's something going on here. The earnings over the last year were up 200%. So they probably had some write-offs the previous year, or they had some big gain that was non-operational, something there. Industry was up 22.4. Sales for Levi Strauss grew at 5.9% over the past year. The industry was down 1.1%. And the analysts got a 5-year earnings per share growth estimate of 7.6%, pretty good compared to the industry at 2%. I do like to see that they pay a dividend, 2.9%, use 57% of their earnings to pay that out. Look at the balance sheet, current ratio, is 1.5 versus 2. I'm okay with that. Debt to equity 1.1 versus 1.8. That's okay as well. We do see a net profit margin of 5.6 versus 4.5. Usually retailers don't have a big profit margin, but that's pretty good at 5.6%. Return on equity 17.5 versus 19.7. And they have free cash flow of $442 million. That is about half the industry at $820 million. But I'm thinking this is okay. I guess it's going to depend on what you find for the earnings going forward.
Yeah, let's take a look at those numbers here. Levi Strauss, again, their ticker symbol LEVI. Levi, nice and easy. I said we picked some easy companies here today with Kava, ticker symbol Levi, ticker symbol there. I mean, nice and simple. But again, their current price is at $17.74, 52-week range. The low, it did hit $12.17, and the high here is $24.34. This company looks interesting. And I say that because going out to November 2026, estimated earnings per share of $1.36 gives a target sell price of $22.58 and be an estimated return of about 27-28%. So our margin of safety is 30%, not quite there yet.
Right.
But, it's an interesting business. And the thing that I like about Levi, we like the CEO, Michelle Goss. I think she does a great job with that business. And she is really hyper-focused, I think, on the Levi brand. And they recently announced they're selling their Dockers brand for about $311 million. And it's not a big deal to them, but it really illustrates her emphasis of the business of focusing on the company and I think driving Levi for profitability. And I found this interesting. Dockers was founded in 1986 as a hedge against denim to kind of offer khakis.
Oh, really?
But khakis, people don't really wear anymore.
I was saying, because I remember they were a big thing. It was in the 90s. I forget when it was. And Dockers, I've not heard that name come up at all. And when you said Dockers, I was saying, is that a shoe? What is Dockers? I can't even remember what they were.
But again, she's really focused on saying, well, that business they did about $67 million is what Dockers did in the first quarter. So, I mean, it's not really worth, I think, the time of the company to invest resources, invest people, invest marketing dollars into that. I think they'd be far better off, again, focusing on their core business, which I think is what Michelle Goss is doing there. And I like the move. I think it'll be good. And I think the numbers look okay. I think Levi's, it's an interesting one.
And I know Michelle Goss. She's been on Wall Street for a while. We like her. What her style is, what she does. So I mean, at the right price, and I still think that there's going to be more of a pullback here this summer. This could become a buy with a pullback of 10% or so, maybe. Mm-hmm. So pretty good. All right. Well, let's move on to